Hi, it's John Forlines from Donoghue Forlines. Welcome to the, I guess you'd call it the first half review, although the way it's set up is we're going to review pretty much dwell on both the first and second quarters, and then mostly prospectively, because that's the questions we're getting, and probably you are from your clients as well. What's going to happen from here? Now we've seen a bear market and a bunch of indexes. What could possibly go wrong next? So we're gonna talk about that and give you the scenarios and give you ammunition basically for those of you who are advisors with your clients, and also for those of you who are fiduciaries, with your constituents. So we're gonna get into role shortly. Nick Lobley, of course, is a portfolio manager for the whole GT suite, and I'm Chief Investment Officer and oversee all the products. Actually, we really oversee all the products, and that's actually one of the stories we're going to talk about today. Is that overall we're pretty pleased because in terms of both absolute and relative performance, we have individual vehicles which have outperformed dramatically, and of course the GT suite has done as well, which is, we're thinking in terms of where you want to position clients and have them think. Part of the message that I left you guys with when I sent around a little video this week was, the greatest mistake you could possibly make is to have clients to get into the mindset that they're going to time the market. It's behavioral finance 101, right? And you've seen our charts that, it doesn't, there's not many days available to take advantage of positive attribution. And you can live, Nick's going to show you one later that shows you, it's very possible, in fact, highly, highly, highly probable that you're better off sitting pat with your strategy. That leads to the second point, which is have a strategy for clients and constantly remind them of it, because that's really the name of the game in the advisor and the fiduciary business, is sticking to your plan, and let your vehicles and your managers take on and manage the risk for you. Okay, with that, I'm going to turn it over to Nick. We've got questions coming in. Again, it's kind of an exciting time. You can hear from my voice, I'm really excited actually, because I think we've seen maybe not the worst of this yet. Maybe there's a little bit more, but I feel very positive, and I feel very positive that we've protected folks, and with many of our vehicles, ETS, mutual funds, and blends. So that's one reason I'm up. And the other, of course, is that we're getting into one of my favorite holidays, which is July 4th, where we can step back and think about the reason we're sitting here having this discourse is because we live in a country that allows us to talk about markets, and again, being in the place where there's the most liquid markets in the world. That's a direct function of our laws being the right kind of laws to function with securities markets, and so you rarely see the kind of liquidity we get. And even in places you think, oh, they're highly superior in terms of governance and all this, like Switzerland, liquidity is still really low. It's nothing compared to what we have here. So that's something to be very proud of from just a purely financial perspective. And the other is, let's celebrate the country we live in, and I guess the other message is it's a great time to reach out to people you may not see or even don't get along with and talk, because we all have that shared. Okay, with that, I'm going to send it over to Nick, and I'll pop in there at some point, Nick, and let's go.
Thank you, John. I appreciate that. So, and thank you everyone for taking the time today to be on this call heading into the holiday weekend. So our first slide here is the everything sell-off of 2022 continues, right? So, starting at the beginning of the year and really towards the end of last year, you saw some more speculative areas of the market start to pop, be it super high growth tech stocks, be it cryptocurrencies, be it meme stocks, right? You started to see those start to fold. But really since March, you've really seen almost everything you can own start to roll over, right? Even commodities, even metals, even gold, bonds still selling off, and of course, equities continuing to sell off, hitting the sort of objective mark of a bear market down over 20%. So really, there wasn't much you could have owned over the past 3 months that would have, protected you from what we've seen. And, to make that point is, the 60-40, the 60% equity, 40% bond portfolio is on a historically bad run. So on the pace that it's on right now, it would actually draw down 49% on the year in real terms. So it's off to a historically bad start that it really has never seen, right? You really have to go back to the 1970s where we saw elevated inflation as well, to where you saw this portfolio act the way it did. And the primary reason for that is obviously we're within a equity drawdown, but generally you see bonds sort of hedge. That's why a lot of, sort of the thesis of modern portfolio theory that, bonds hedge equities. We've mentioned a lot over the past year that, this hasn't always been the case. And, you've seen that this year, right? The bonds not only haven't hedged equities, but they've actually been a lot of the trouble that equities have seen, given that we've been in kind of a liquidity crisis with rates moving so high. And how did we get here, right? So obviously, in the shorter term, we had that COVID bust boom that created that sort of transitory supply-demand imbalances that continuing to go on, primarily because of China's zero COVID policy. And then on the medium term, which is really another fuel to the fire, was the monetary and fiscal policies that we enacted to sort of fight the COVID crisis. And quite frankly, probably it lasts a little too long, right? We're under the impression that the Fed sort of made a mistake leaving interest rates as low as they did for as long as they did. And then the fiscal part of that did not help as well. And then on the longer term, you have sort of these changing global forces, which you've seen in, as to mention the slide, the Russia-Ukraine sanctions and, the move away from, I guess, globalization has kind of hurt the structural disinflation we've been in over the past 10 years, right? So it's kind of been a perfect storm of things that we've gotten to this point. And it's certainly affected portfolios almost everywhere now, even, right? So we saw sort of I mentioned we saw sort of a bifurcated market at the beginning of the year, but now we're kind of hitting the level where it's a liquidity crisis. Almost everything is starting to sell off, right? As you can see, even commodities are down more than equity and bonds over the past month and a half. And that's because the Fed, as I mentioned, we believe they were sort of late to do this, but the Fed has started twin monetary tightening, and when it has created this sort of liquidity squeeze. So not only are they raising short-term rates, which most recently raising 75 basis points in one meeting, first time done that in a very long time, and as well as they're rolling over their balance sheet, right, of what they hold, of the bonds they hold and that on their balance sheet, right? So not only are they raising rates, but they're also rolling over their balance sheet. So it's sort of this twin tightening that we're seeing, and it's creating this liquidity crisis, especially in growthier areas of the market. At the same time, though, and this is really what's changed over the past few months, right, is the U.S. economy has broadly started to slow. On sort of the top half here, you can see the Atlanta Fed GDP now, which sort of projects quarterly GDP on a weekly basis, and then you see the economic surprise index, which shows you how economic projections are coming in versus expectations, and both are starting to not only have rolled over, but are moving in sort of contractionary territory, especially after we just saw a negative GDP print in Q1. So the economy is starting to slow, but the Fed is kind of on full gear here, right? So we're as we'll mention a little later, we think the Fed might be actually up to another mistake here. The next shoe to fall also might be the housing market, right? It was kind of stood up between all this, and mortgage spreads is something we're watching pretty closely right now, and they kind of signal trouble ahead for credit markets, be it investment grade or high yield. So that's sort of the other shoe to fall, and really kind of comes into our golden rule, right? Our golden rule is to try to stay invested unless there's a recession. So banks and other strategists are kind of tripping over themselves to starting to add recessionary risk to the market, right? A lot of people are starting to call for a recession as it happens, later, right? Recessions are only in hindsight, are only determined in hindsight, and a lot of the times, market forecasters predict them in hindsight as well. So, our golden rule is always to stay invested if you're not within a recession. So here's the question: are we in a recession, right? And from our view, is a lot of this is priced in, right? So markets discount prices So, probably around, it depends on the scenario we're in, but around 6 to 9 months ahead of macro conditions, markets will price in. So if you look at financial conditions, and this is something the Federal Reserve also looks at, which is important, right? And financial conditions are, interest rate increases, currencies, credit spreads, and as well, and stock prices, right? So everyone talks about, the Fed doesn't look to the stock market, but they admit that they look at financial conditions, and the stock market is actually a part of that. So if you've seen similar moves in the tightening of the financial conditions tightened quite a bit already, right? So if you've seen similar moves on a 6-month rate of change, it actually coincides with close to bottoms within the S&P 500. So financial conditions have tightened like other recessions already. So the question is, how mild is recession? How deep is it? And how close are we to a bottom, right? So another point is that, equities tend to trade sideways prior to recession, right? And we certainly haven't been doing that. So I guess another point I'm making is for us, the question really is not where we're looking at 6 to 9 months from now. Are we in a recession right now is the real question, right? So we saw negative growth in Q1. Are we going to see it in Q2? And we think that's possible, right? That we could see a mild recession in Q2. But looking out, we're a little more positive, right? So we've already kind of seen that. If you look at the right side of the chart, that downtick we've seen. So, we're a little more positive there. And then that comes the question, are we in a recession, right? So unemployment has started to tick up a little bit if you look at initial jobless claims, but still sort of under the natural rate predicted by the CBO. So obviously this market's been, economic data has been tough to decipher really since COVID, and it continues to be, right? In 16 months, we basically got down to where we were pre-COVID, and a lot had gone down since then, right? A 30% contraction in growth, and sort of record unemployment that we saw during that time period. So it was pretty incredible, how we snapped back there. And then the question is, how we're going forward. So to answer some of these questions, I'm going to turn it back over to John and some of our probabilities of what we think is going to happen. John?
Okay. Thanks so much, Nick. That was great. Especially the part about the, setting it up really or teeing it up for the scenario analysis, right? Because that's what advisors and fiduciaries want to know, like what could happen here. So here's a chart that needs a little unpacking, but the best way to look at it is you can only put probabilities on the future. It's just one of the reasons Nick and I get a hoot. We don't watch much financial TV, of course, but when we do, it's a hoot to watch people actually say this is going to happen or that's going to happen. And, for us, that's just not the way we work. We try to provide ourselves with probabilities. We weight them. And then we make decisions, with a lot of data. So that's how we work, and it's not something producers on, these shows want. They want somebody just to name stock prices that are going to go up, right, or down. So here, take a look. If we're going to have a mild recession, that Nick indicates is probably the one. If you think about it, is probably where we are. Given the fact the first quarter was mild, the second quarter is probably going to be mixed and mild. You might even have the third quarter being worse than the second, but nevertheless, is that looking at mild to deep, this is where the numbers are. So if you think about where the markets have been, where the bond markets have been, we've already, I think Nick pointed this out, that we're already pricing in much more than a mild recession, and somewhat less than a deep recession. And so if you look at it in terms of where we're going to be in after we get out of it, you're still better off, as Nick points out, and I think we have time and time again. You're still better off having a strategy and sticking with it. Not often clients will say, "Gee, I just want to get out of the market," and the answer is you can never, if you're allocated properly, you should never even think about that. It shouldn't come to, it's for people who aren't allocated that probably have, should be using advisors and and should be looking for better opinions than the ones they currently have. But notice if it's a mild recession, you're actually in a pretty good shape. You're going to come out of it kind of like the last deep recession we had, which was back in 2007 and 8. And even if you look at the pandemic recession, which is incredibly brief, it actually turned out to be not much of a recession. The market way overreacted. And you could say the same thing has happened here, where the market's traded back down to those levels. Everybody goes, it's the fear factor. But again, holding your own means even in the worst case, you're not too bad off. And this is something you can dig your way out of, like the previous ones. Okay, so let's go then to what are some components here. Well, one's macro stress. What could produce a mild recession is probably the fallout we've started to have that Nick mentioned. I'll throw a few more for you. Like you saw the unemployment spike during the pandemic and post-pandemic, but guess what? There's a tremendous amount of announced layoffs and, in fact, unannounced layoffs. We know that because we follow the tech sector very closely. And there's a ton of companies laying off software engineers and marketers and programmers and all kinds of folks. So that's going to be part of the stress index coming forward, and the Fed's going to obviously keep its eye on that, because if you think about all those things the Fed looks at in terms of financial conditions, the mandate, I call it the sort of the agency and legislative mandate, is prices and employment, and of course, employment's a huge part of it. So that's one that could slow that train down, which everybody, of course, is traded on. Now, the next one is interesting. The energy markets. That's sort of the other one, right? You almost always have. Think about it this way: if you look at back in probably the worst recession of our lifetime, the 08, 09, 07, 08 one, which of course market effects went into 09. What you'll find is that the price of oil in 2008 was about $135 a barrel. So we're on a real basis, we're not there, but it's still relative to what consumer expectations were, and of course relative to some of the supply issues with the Ukrainian war, have caused real dislocations in the market, and there's a huge overshoot going on. So is that going to also trend down? I would argue that a little known thing that happened just the last 48 hours is a big deal, where Turkey dropped its reluctance to allow Finland and Sweden into NATO. Well, that means that there's more pressure than ever on Russia to try to figure out a way to get out of this, and therefore you probably shorten the timeline of that conflict, and that means that's a very positive one for the consumers of energy, and probably a warning for those who have made money on these prices. So there's number 1 and 2, and then guess what? We had this spike in inflation expectations that came out of the pandemic, and then were fulfilled through energy and fulfilled through commodity prices and food prices, and then went to the pump, right, for people in energy, which is a classic pace. But right now, those expectations have started to fall, and all you have to do is look at the forward curves. And you look at sort of some of the not only connecting the commodity dots with rates dots, you're going to find that those expectations, which of course that's what inflation is all about, is how people expect prices to be, because that determines what their current behavior is. Do we buy now? Do we wait? Do we sell now, or do we wait? Right? And I think the bottom line is this is another indicator that we probably are heading to something that may have mostly been discounted in the marketplace. That's not to say we could be wrong about that. It's just that, just like you saw with the bear market scenario analysis we showed you above, really bad stuff happens in markets, and if you stuck it out, if you had a plan, this is just NASDAQ, for gosh sakes. If you had a diversified portfolio, probably a lower total return, but a lot more sleeping at night for those of you who are more emotionally inclined to think about these things. But this is the point I want to make, is these things happen, And it's our job as managers to manage the risk and the emotional impact for clients, and that's exactly what we do. We've had some questions about how we've built our products, and many of our products are built to keep clients from feeling the full effect of bear markets. And as a result, we feel we have to spend a lot of time explaining to people sometimes about how you have to give up some upside if you want to do that, but for us it's worth it, because the bottom line is, if we can just have what we think is a solid return over time. And if you saw that scenario analysis chart, which we'll probably go back to during questions, you'll see that even with a deep recession over the next 12 months, you're looking at still a sort of an 8% return annualized, which is not too far from a target for a diversified portfolio. So let's go to performance. Let's look at the blends, and in terms of what's happened this year for us, so that we have individual market products and income, dividend yield, growth and income. We have mutual funds, and we have ETFs, and one of the things I hope you do is go explore the website. We have really, for the since we've come together, since Donoghue Forlines really came together back now 4.5 years ago, we've really got it where we want to be in terms of, we have the types of products on an individual basis that make up great constituents for our global tactical suite. And we also have individual products which advisors can buy. So we have the ability to serve folks with managed accounts. We have the ability to serve people with mutual funds if they want to buy them. And we also have the same thing on the ETF side. And so I encourage you to go see, see what we've done, particularly if you think about it. Look at the broad tech indexes. The big ones, they're down 23 to 33, 34%. And then you look at some of the specialized tech ones, the ones that are concentrated and have been very popular in recent recent years. Those are down over 50%. Those ones that are hyper focused, and we don't think tech is particularly a sector you should be that focused that way. It should be, you should have a method like we do, which is picking out free cash flow companies, and how much research goes into and thoughtful research goes into new products and other stuff. And that's worked so much better, much less drawdown if you compare us to some of those specialized and very popular ETFs. The same way, our income products have outperformed. We have, I invite you to go see, but we have a rates product that this #1 in this category at Morningstar. So we have a lot of great, I would call them surprises for folks who, again, want to work with us. They like our research, but they may manage their own portfolios, and we'll say to them, fine. And there's others who like our managed portfolios. They like the fact that we do what we say we're going to do, and we can explain it to people, and that's how it should work. So again, there's something for everybody at Donoghue Forlines. Okay, so in terms of actual performance, again, this kind of emphasizes my point. If you look at what we've done, benchmarks are kind of hard since we don't really fit any benchmark. But people, we have to give different platforms, and we actually have different benchmarks. Most of them allocation type benchmarks, and occasionally some of them like the hedge fund index, which we show. But the bottom line is the absolute return has been extraordinarily good relative to the main market. If you call the current slide, just a lot of advisors kind of look at things like the broad technology index, which is quite popular, and of course the S&P 500, which is another one. Well, the S&P is down in excess of 22%, maybe a little more after the last 2 days. And for us, we're half that, and that's exactly how it should work, right, over time. And because the recent performance, we're a little bit low on what we'd like from inception, but we're going to get back there. That's just the way recent performance impacts the whole the whole return chain. So I feel like we've weathered a big storm, and now we've got some opportunities. So with that, Nick, I see we're heading toward the bottom of the hour. Let's get into questions.
Perfect. Thanks, John. Let me pop our first question up. Okay, so the first question, John, is to provide specific on how our portfolios have been positioned to address current markets and what potential changes do we foresee in the coming months?
Okay, so why don't you go back to the performance? I'll talk a little bit about that, the performance slide, Nick. And what I would say is, and this is a really good question. This comes from Eric over in New Jersey. Eric, what I would say is that our constituent components, particularly if you look at some of the ones we've had in there, first half has been dominated by our commodity vehicle, and we've had great success with that. We, up to that point, we had rode innovation, but even innovation, where we've kept a good amount of exposure, has way outperformed other tech, and that's important, because that's part of the game is you want vehicles underneath the cover that do that. And along the way, what we like about the managed accounts is there's no wrapper fee to advisors, so you're getting that kind of strategic portfolio allocation, and our pricing is in what underneath the covers, which is in those products, and the vast majority of them are incredibly well priced relative to peers. So we feel like we're ahead on those counts. And again, tactically, nothing different than the fact that we've had the right blends in there, the right vehicles in there, in the right proportion. And we also remember there's a number of our vehicles have triggers which to move to treasuries when there's a tremendous amount of volatility, and you've seen that with high yield, and you've seen that with some of the float, the rates products. And we haven't hit that level yet with, for example, our innovation product. So we don't, we're not sure. It might trigger, but if it does trigger, it's going to be really super short. But that'll also take some of the sting out if there is any, remainder left here, which, most people, including, folks on our own investment committee, think we're probably, from a technical perspective, probably going to have some more drawdown from here. But again, the real question is, how long does that last? And then can you ride that storm out, because it's always bright on the other side.
Thanks, Sean. And then, and next question is what are you looking at to trigger sort of a deeper recession, even though it's not the house view? What is something we look at to sort of trigger that?
So, I think I don't think it's financial, Nick. I think I think it's basically, I think a lot of the finance stuff is built into the cake. The sharp rise, relatively sharp rise in rates, and then the reaction to that, and then you've got lots of the stuff that's starting to fall off that was just exorbitantly high. For example, you're going to see that unemployment number come up. You may not see the claims, which is unfortunate, because the fact of the matter is a lot of folks who are independent contractors are probably moving on to something else, or they're taking lower jobs, or they're going to take time off. That's the key. The element behind the pandemic is a lot of the job statistics are going to have to be relooked at down the road. So that's one thing. And then inflation is starting to fall off. You still have these just absolutely absurd increases in some of the precious, not precious, but industrial metal complex. And that's probably going to tail off. And again, I think the other point, Nick, if you want to talk about a driver to the other side, is a Ukrainian war that just drags on and on and on. Obviously the Germans particularly would love to have it settled soon so that they can go back and take the cap off Russian gas and start buying it again. That's not going to happen, I don't think. So, that could be a factor in something more than mild, probably not deep, but still bad. Bad meaning in those numbers we talked about, which are, if you look at the sort of the middle ground where the S&P is down in the sort of the 30s. Here's a good one for you.
Thanks, John.
Here, I got one for you that came in. We have one of our real great advisor groups that actually have a conclave going on. So I'm sure many of them will be listening to this recording. But this came from down there. I'll ask you this question, Nick, since you're a hell of a lot younger than I am. But the pullback in cryptos, what do you think? Do you think you'll have an impact on markets? I mean, I could talk about the long-term stuff with crypto, but that doesn't really help anybody, right? What's this big giant fall off and super bear market in cryptos? Will it have an impact on the markets that we invest in?
Thanks, John. And so to start this off, crypto has seen this before, right? So they've seen giant bear markets like this. What they haven't seen before is the institutional adoption leading into this, right? I'm sure everyone's, not only were banks signing up to have clients access crypto, you saw ETFs coming out. I'm sure your favorite celebrity was, either pumping crypto or some sort of NFT on their social media, right? So we didn't have this type of adoption and wealth effect that was going on during this last run-up, right? So, Bitcoin and Ethereum and other, sort of major cryptocurrencies have seen these type of drawdowns, but we really haven't seen the wealth effect that we've seen this past time, right? So a lot of people actually, the adoption was up a lot, right? So a lot of people actually, bought into this and have lost money on it, right? As opposed to, prior bear markets within the industry. So I think that's had a effect on the market. And I think, look, I think part of it too is, right, we've seen a lot of risk in the markets. And when people go risk off, the first thing they sell are the riskiest parts of their portfolio. And for a lot of people, I'm not sure what would be riskier than crypto, maybe levered positions. But for a lot of people, cryptocurrencies are the most risky part of their portfolio, right? So there's certainly, a lot of network effects there, and it's to remain to be seen if it's a viable solution in the future. And, I'm sure a lot of people have opinions on it, but it certainly has had an effect, I think, more than it ever has because of the wealth effect it's had on markets with this recent run up, right? So it's not exactly the same crypto winter as we've seen in the past, but the volatility in these currencies have happened before, and it's remained to be seen if they'll rally out of that. And the funny thing is, really, it's sort of billed as a hedge, right, against inflation, against other asset classes, and the devaluing of that. But in reality, it's sort of just traded like the NASDAQ 100 with leverage, right? So when stocks are up, it tends to be up, and when stocks are down, it's down more. So it's been quite correlated with the rest of the market, and I think that's kind of what I mentioned before. When people start to go risk off, the riskiest part of their portfolio, they sell first, and I think you've seen quite a bit of that. And look, the market kind of needed this, right? You've seen a lot of fringe players in crypto, more the scammer types, sort of that were using a ton of leverage, sort of getting washed out here. You just saw one of the bigger hedge funds in the cryptocurrency space default. You've seen exchanges have issues. So certainly, there's always going to be people sort of chasing returns that are, uncharacteristic, right? You're always going to see, depending on whatever asset class it is. And cryptocurrency has been that speculation of the time, but I did think it had an effect on the sell-off, and it remains to be seen, whether it'll rally with the rest. But I sort of expect that market to, eventually when the equity market recovers, for that market to recover as well.
Yeah, that's a really good. Now, in terms of the applications, I was thinking just while you were talking, this period, this big crash reminds me of the first internet crash back in Alt 1 and through Alt 3, 2001 and 3. And everybody said, well, that's the end of the internet stocks. And the truth is the winners were allowed to emerge. There was a whole tons of stuff, NASDAQ being down 75% or something, but and funds wiped out and all that kind of stuff. But bottom line is you had online shopping emerge as a principal way people get goods. That came out of that era. You had networking through collaborative applications that grew up in that era, which everybody now uses, right? You had huge advances in chips that drive video. And of course, all you have to do is look on your children's or teenagers or grand people's phones to see that that's a big use by a lot of people, not to mention us, business people. We use, like we're doing now, we use video applications and broadband applications that are, came out of development from that period. So that's number one. The good always comes out of it. So then you might want to ask yourself, okay, what possible good could come out of this new boom in cryptocurrency? And I think the one way to look at it is there's two things. When it started in the first place, if you go back to 2010, 11, 12, the premise was, okay, one, crypto, particularly Bitcoin and then Ethereum, they could provide us with alternative currencies on the theory that, everybody knows that central banks mess around with their currencies, and from the Americans to Chinese, everybody does it. So don't we want some kind of decentralized currency protocol where that can't happen? So that was set up as an alternative. So let's not check that box yet, because as Nick points out, that's not how in this current environment, that's not how currencies behave, right? You don't have these giant plunges unless, of course, you've defaulted. Now that looks more like what we've seen now. The second premise of cryptocurrency really goes back to the blockchain. And my guess is that is the science that's going to emerge and that people will build platforms off of in the future that will be valuable. Because right now, it's not valuable if you look at the coins themselves, because the process is so slow, and there's not, despite what the marketers of cryptocurrency want you to know, that it's liquid market, it's really not. And it's too expensive, and in many cases it's environmentally threatening. So, and those things that's why I think people get messed up when they start thinking about the coins and not look at the stuff that blockchain could transform. I'll give you an example. The art market is a great one, where those are physical objects we look at. And one of the big problems in the established art market is veracity. Is that a real piece of art or not? And so as the art changes hands, it can be attached to an NFT structure where it has to be on that blockchain, or it's not, it's not real. That's valuable. The other is, if let's say you're a beginning artist and you're becoming famous, wouldn't you love to have all your art to draw a commission on it, just like we do in the music business when someone plays your songs, where you'll get a little piece of it every time it changes hands? Well, NFTs can do that, and that's blockchain oriented, right? I think the same thing about anything you look at, like sports memorabilia, certain of it that's not physical, like Topps cards and things like that. That's very possible. That's market, along with sports videos, that could all be part of what we're talking about in terms of value. So I don't know what the other applications, my son, who is an expert in this, can probably enlighten you. but that's not part of this quarterly end. But again, we had a. I'm glad you guys down in Birmingham raised this question, because I know a lot of advisors have, are essentially getting those questions.
Thanks, John. So the last question we'll wrap up with here is, how far do we see the Fed continuing to raise interest rates?
Well, again, that requires for prediction, and those of you who know me as a behavioral scientist don't want to predict the future, but I think the bottom line is that we're already at we're starting to get toward the bottom range historically, right? We're, Nick, if you correct me if I'm wrong, but we're looking at $1.50, probably going. My guess is in July we'll probably go to that lower threshold number, which is around 250. $1.75 is 250, right? So the lower threshold historically on the tightest you can get where the Fed funds is 250 to 425. That's your range. Anything larger than that, which is like 2007-ish, is probably a mistake. And anything smaller than that is probably undershooting. So that's what I don't think we're that far away from it. I could be wrong about this, specific. That's a range itself. I'm not wrong about the range, but I feel we could be. There should be some dots inside it that I may not see. But that's kind of where we see it. Okay. Anything else? Anything else, Nick? Do you want to raise?
That's it, but I'll close it with this. John's not going to brag about himself, but want to say congratulations for your Duke course on behavioral finance, named one of the best personal finance courses of 2022 by Investopedia. So, for all of our advisors, keep an eye out. We do a lot of these behavioral finance type webinars too. So, John was awarded there. So congratulations there, John.
Well, thank you so much. It's a blessing to teach, and it's sometimes it gets lonely when you tell people, hey, you have to stay the course as long as you have a plan. But yet that's what we're saying. Okay, well, yep. Nick, a great job as usual. Liz, thank you so much, and to all our advisors and fiduciaries, thank you for investing with us. Again, head back to the website. You'll find a lot of new stuff on there. And of course, you can find plenty of information on what we do. Attached to this invitation is our latest Markets in Motion, which talks about some of the things we discussed today. And then if you have clients, if you have other concerns, drop us a line and we'll respond. This slide is not it's not advertising. We have an open line you have an open line as an advisor to our research analysts and portfolio team, and we will get back to you with our judgment, our answers and our judgments. And so we appreciate the support, but again, we're here to help. So reach out to us and let us know what you feel and also what we can do better. With that, everybody have a wonderful 4th, and to stay healthy, stay well, and we'll see you on the other side.